Everybody, this is Kevin, a CPA that does financial planning, and today I'm going to talk about, would you give your money over to someone or an entity and absolutely expect to get back less money? Well, that's what's happening right now in Europe and parts of Asia. So Germany, right now, if you buy bonds, German bonds, you're giving your money to the government and they're going to pay you back. It's actually negative interest rates. They're going to pay you back less than you give them. Same with Switzerland, same with Japan and Asia. Why are people doing this? And how will this affect our investment? Well, first of all, there's maybe three reasons why people believe that bonds continue to be purchased, although they have a negative expected return as far as interest rates go. The first is a flight to quality, okay? So those three countries that I mentioned, along with the US, these are highly developed countries. There's a feeling that, more than a feeling, I mean a history that you've given your money to them and you've gotten your money back. So Germany just had a negative GDP number. Japan, I believe, also had a negative GDP number in the latest quarter. So people feel like, well, if I put my money in bonds, at least I know I'll get it back. If I put my money in the stock market, maybe a recession is coming, all this other stuff that we hear about, Brexit, recession, Europe is in trouble. So anyway, all of these negative things might be forcing money into bonds, although once again, you're expecting to get back less money. So that's number one. Number two is that there is a potential to get capital gains, okay? So it's a little crazy how bonds work, but bonds will go up in value and then their yield will go down as a percentage. And so if people keep buying these European bonds and they keep going up because there's only so much supply and demand, they're buying, they could sell those bonds for a capital gain, even though they're losing money on the yield every year. So that's a potential. There's also the potential that US and foreign investors are buying these bonds. DFA put out a piece that said that if you buy bonds in US dollars and you hedge, you can see the yield curve is negative in Germany, but when you hedge it, it actually turns out slightly positive. And so that might be a reason. Now, the fourth reason that I've heard, I don't know if I believe it, but maybe someone knows better than me that works in the insurance industry, is it's liability-driven investing, and they're matching liabilities to their investments or their investments to liability. So when they have to pay out life insurance in 10 years, they have the money available. I wouldn't think that insurance companies would do something like that. The other potential is it's because of all this quantitative easing and countries are buying their own debt, which that kind of makes me scratch my head as well. But these are all the reasons. The experts don't seem to know. So the bottom line is this: is it concerning? Yes. Is it unprecedented? No. It's happened before, but it is something that could freak investors out. So we come back to the fact that bonds are really used as a safety mechanism. If you're going to own bonds, for the most part, we recommend that you own treasury bonds and safer bonds. If you're going to invest in foreign markets, hedge it, because there's only this much return that's available on bonds right now. You don't want to lose your return because the currency goes against you. But use bonds as a place when stocks do go down, that they will probably move in inverse to stocks. And the second issue is, it seems like things are crazy right now. We have the inverted yield curve. We have a recession potentially coming because the inverted yield curve. We have these negative interest rates. There's a lot of fear out there. I would just remind everybody that the reason why equities and REITs have such high expected returns is because you need to hold them during times of fear. And so to really think about what your asset allocation is in stocks and bonds, speak with us about it. If you're concerned at all, speak with us. If you have more bonds in the portfolio that are very safe, high quality bonds, probabilistically, most likely speaking, if interest rates do continue to go down, the bonds will go up in value. If stocks go down and fall, bonds will go up in value typically. And so it's just all about just making sure you're comfortable with your asset allocation. One of the most important decisions that we make together. So everybody, thanks so much for watching. Hope everyone is well. Again, Kevin, a CPA that does financial planning. Thanks.